Hi, this is Lara at Elliott Wave Gold and also from Elliott Wave Stock Market with your Lara's weekly analysis of oil and then gold and then the S&P 500. Lara's weekly is an end-of-week Elliott Wave and technical analysis of those three markets, focusing on the mid to long-term picture. It's designed for investors and swing traders. It's not appropriate for day traders. At this time, it's available to the general public, and next weekend will be the last time it will be freely available. After that, I'll be offering a once-only awesome grandfather rate to earliest subscribers for Lara's Weekly, and I'll be launching it as a paid subscription service. So if you want to make sure that you get your grandfather rate and be notified, click down on the link on my YouTube channel below and go to our website. Click on the Lara's, or it'll take you straight into the Lara's Weekly analysis, and on the little blue Notify Me button, just give us your email address there. I'll only be using those emails once for the purpose of notifying you of the launch of this subscription and the grandfather rate offer, and after that I'll be deleting that list. I will not be using it for anything else. For my main wave count for oil, price must continue lower here for that wave count to make sense. If price makes a new high above 66.65, my main bearish Elliott wave count for oil will substantially reduce in probability, and that will increase the probability that oil may be in a huge new bull market. That would have final confidence if price makes a new high above 74.96. Classic technical analysis this week still favours a bullish outlook for the bigger picture, but for the short term, the volume profile is a bit bearish. It looks like price may continue lower for a week or so, and that's what both wave counts expect for the short to mid term. If price does turn strongly lower here, the target for the bearish wave count remains at 13.39. Elliott wave analysis first for oil this week, classic analysis last. I have two wave counts at the monthly chart level for oil. Both of them see a super cycle degree, second wave zigzag beginning here, and this first bearish wave count sees super cycle wave 2 incomplete, subdividing as a zigzag 5, 3, 5. Prime cycle C, an incomplete impulse, subdividing 1, 2, 3, 4, and needing a fifth wave down. The target I'm calculating is at primary degree, where primary 5 to reach only equality in length with primary 1. It would be truncated. I'm using a Fibonacci ratio to primary 3 to calculate the target. When there's more structure within primary 5, if this wave count turns out to be correct, specifically when there's intermediate waves 1, 2, 3 and 4 within it, I'll calculate a better target at intermediate degree. I can't do that yet. There's some alternation and almost perfect proportion within this impulse of cycle C. The duration, or sometimes the size distance travelled between second and fourth wave corrections, is what gives the wave count the right look. So it's the proportion between the second and fourth waves within an impulse. And here, primary 2 lasted 2 months, and primary 4, if it's over here, primary 2 lasted 22 months, and primary 4 may have been only 1 month longer, lasting 23 months. So almost perfect proportion. But they are both zigzags, and their B waves within them are both triangles, so there's poor alternation in structure. There's excellent alternation in depth. Primary 2 is deep, primary 4 is shallow. Alternation in Elliott wave is a guideline, not a rule, and it quite simply is not always seen. That's why it's a guideline and not a rule. The lack of alternation in structure here does not mean this wave count must be wrong. It just reduces the probability of it, and that's one big reason why I've been publishing a bullish alternate that removes this problem of alternation here. Let's take a look at the structure of primary 4 at the weekly chart level. Before we go there, the invalidation here is black and white. Any movement by any amount at any time frame above 74.96 will be an invalidation, will be a violation of the rule that 4 can't move into 1, and that will invalidate this wave count. For this market, I am not going to accept a small overlap. It should not overlap into wave 1 price territory. Let's take a look at primary 4 now at the weekly chart level. There's this point down here. Here's the zigzag of primary 4, subdividing 5, 3, 5. Intermediate C, if it's begun here, is now a nice complete 5-wave impulse. Primary 4 has very little room to move into. It can't move up into primary 1 price territory, and that price point isn't that far away now. So if this wave count's correct, it really should be over here. This wave count needs to see a 5-wave structure down for primary wave 5. It has to end beyond the end of primary 3 at 26.86 to avoid a truncation. The strongest piece of analysis on this chart is this Elliott channel. Draw a channel around a zigzag from the start of wave A to the end of wave B, place a parallel copy on the end of wave A. While price remains within this channel, we do not have confidence that primary 4 is over. This channel must be breached with at least one full daily candlestick below and not touching this trend line before we can have reasonable confidence in this wave count, or at least that we have a high in place and a new wave down has begun. While price remains within this channel, the possibility that that bullish wave count is correct and this bearish wave count is wrong will still be reasonably high. That's the caveat with this wave count. Let's take a look at how primary 5 might have begun now with the end of primary 4 up here, this point up here. We could have an impulse down here for minor 1, a very, very deep double zigzag for minor 2. I think it's a 99% correction of minor 1, may have ended just before the invalidation point. This is actually really typical behaviour for oil. I'm just going to quickly go back to the monthly chart and tell you what I mean. If you look at how this started here, this primary wave 2 here is a very deep 94% correction of primary wave 1. Intermediate wave 2 is also very deep, a correction of intermediate wave 1. Oil does often start out its new trends with very, very deep second waves. That's one of the features of this market I've learned over the years. And so it's a tense time when oil does that, but it really should be expected. There's nothing new in this behaviour here. While price remains below this invalidation point, the Elliott wave structure says that this should be the preferred wave count. However, I do have a strong caveat. The monthly chart technical analysis does not support this first wave count. We'll get to that next. The target I'm expecting for minor wave 3 expects the most common Fibonacci ratio to minor wave 1 of 1.618. That's achieved at 52.20. Along the way down, if we see a new low by any amount at any time frame below 55.24, this first bearish wave count would have reasonable confidence. And also we need to see that channel on the weekly chart breached to have reasonable confidence that we have a high in place, remember. At the monthly chart level, this is my alternate wave count. It's very bullish. It looks at the zigzag possibly complete for supercycle wave 2, subdividing 5, 3, 5. If cycle B is over here rather than at this major high here, if it ended later, then this is where cycle C begins, and cycle C is a nice complete 5-wave impulse. Cycle B here, a zigzag, 5, 3, 5, with a 9-wave triangle within it. For primary wave B, that's a little bit unusual. I think I've only seen one of these before, but the subdivisions all fit. It all fits nicely within the triangle trend lines. And the last few waves end short of the trend lines, so that all has a fairly typical look. Primary C is not truncated. It does move beyond the end of primary A. The term truncation refers to where C ends in relation to A, or for a fifth wave in relation to the prior third wave, not where C ends in relation to the correction that comes immediately before it. So there's no truncation here. And so this wave count is entirely reasonable. And it does have support at this stage at the monthly chart level from classic technical analysis, so it should be taken seriously. If we see a new high by any amount at any time frame above 74.96, this would be my only Elliott wave count at the monthly chart level, and then we'd be looking at alternates for the shorter term structures unfolding along the way up. If oil is in a new bull market, then supercycle 2 must have ended and supercycle 3 must have begun. It must move above the end of supercycle 1 at 146.73, and it must move far enough above that point to allow subsequent room for supercycle wave 4 to unfold and remain above first wave price territory. So this wave count would be expecting a very, very substantial bull market to last possibly for decades. This is a very, very bullish wave count. I don't have a target for supercycle 3 because the data does not go back far enough to show me where supercycle wave 1 began. So I can't calculate the length of supercycle 1 and use a Fibonacci ratio to calculate a target for supercycle 3. Within supercycle 3, cycle wave 1 looks like it might be unfolding as a 5-wave impulse. It would be incomplete, and when it is complete and cycle 2 arrives, cycle 2 may not move beyond the start of 1 below 26.06. Let's look at the weekly chart now, where the low for supercycle 2 could have been this point down here. Supercycle 3 may have begun with 1, 2, 1, 2, and now 3, and now 4 may be unfolding, and then we could have a final 5th wave up to complete a primary degree 3rd wave. Intermediate 4 must remain above intermediate wave 1 price territory. Intermediate wave 1 has its price extreme within minor 4 within it at 55.24. I will not allow an overlap of 4 into 1. I know that can sometimes happen in futures markets, but every time I have tried to rely on that possibly being a little bit elastic with that rule, it's always turned out to be wrong. I'm not going to allow an overlap of 4 into 1 because that would substantially reduce the probability of this wave count and increase the probability of the bearish. This Elliott channel would possibly provide support for intermediate wave 4 if it turns out to be long lasting enough, but it looks like it can't get down there. It looks like it may end midway within the channel. Intermediate wave 2 here is labelled as a double zigzag, and it lasted 17 weeks. And so for intermediate 4 to have reasonable proportion and for the impulse of primary 3 to have a reasonable look, it is extremely unlikely to be over here. It looks like it needs to take up more time to have better proportion to its counterpart second wave, and so it looks like it's going to continue sideways as a flat combination or triangle, and those would be the most likely structures to provide structural alternation with the double zigzag of intermediate wave 2. Let's look at how intermediate 4 may be unfolding at the daily chart level, where intermediate 3, maybe this point up here, intermediate wave 4 may be unfolding as a regular flat correction with a 3-wave structure for A, a 3-wave structure for B, which is a 99% correction of A, so the minimum requirement for a flat for B to be 90%, the length of A has been met, and now it needs a 5-wave structure down for C. So both of my wave counts do expect some downward movement for the next week or so. For this one, minus C would be extremely likely to move below the end of A, below 58.13, to avoid a truncation. If it is truncated, it wouldn't technically be a running flat if B is over here, because B has not moved beyond the end of A, but C would be very unlikely to be truncated. The target would see C reach equality in length with A, and intermediate 4 remain above the invalidation point, and C would move beyond the end of A. C would be very likely to end at the lower edge of this Elliott channel, because if this is a regular flat, then it would be very likely to be nicely contained within a parallel channel. Let's look at some classic analysis now and go over why I say that my alternate wave count is actually looking a bit more likely than my main Elliott wave count now. This is the monthly chart for oil for some classic technical analysis. This first part of this upward movement does have some support from volume. This would be a middle of a 3rd wave. There is a little bit of support from volume here, but this is the only thing that's bearish on this chart, and it is reasonably bearish. Strongest volume in recent movement here has come from these downward months. This one here and this one, the 2 strongest months, are downward months, suggesting that there's more support within this movement from volume for downward movement than there is from upward movement. However, for the short term, for the last 3 now complete months, there's more support for upward months, this one and this one, than there is for downward months. Along with this bullish long lower wick here, this wick and the short-term volume profile here suggests another upward month to follow, which might be enough to invalidate my bearish Elliott wave count. We'll see how that works. RSI is neutral. There's plenty of room for price to rise or fall. MACD is bullish. This is a lagging indicator though. If we've got a high in place, it's not going to tell us until after the fact. On balance, volume is still reasonably bullish. What about the short-term picture at the daily chart level for oil? We had some support for this downward movement here from price by rising volume, and that's good to see when that happens. For a price to fall sustainably, it doesn't need support from volume, but when you do see support from volume, you can have more confidence in a downward trend. Thursday's session is quite light in volume. Well, to be expected, it was the last trading day before the Easter break, so should be quite light. It's an upward day with a slightly longer lower wick. Along with this slightly longer lower wick for Wednesday, these two wicks are a bit bullish. This suggests a little bit more upward movement to begin the next trading week is quite likely. ADX is now flat, no longer indicating a clear trend. ATR is flat as price moves sideways. That's normal behaviour for ATR when price is consolidating, or also in the beginning or end stages of a trend. We've got a bearish signal from on-balance volume with a break below support here, previously provided resistance. Here's a bullish signal here, and now we've got a bearish signal with a break below support. On-balance volume coming up now to test what's now resistance, which was prior support. This may assist to halt the rise in price. This may be another bearish signal, resistance here on balance volume. RSI is neutral, plenty of room for price to rise or fall. Stochastics is overbought. And so with the bearish signals from on balance volume and stochastics overbought, it looks like we may overall be getting some downward movement. But for the very short term, when markets open, a little bit more of a bounce before that downward movement resumes is what I'm expecting. Oil and its volatility index now have a reasonable positive relationship. It's normally assumed that they should have a negative relationship. The maths proves that that is absolutely not the case. There are no signals there. There's no reliability whatsoever in their negative relationship because currently it just doesn't exist. And so I will not be using that to look for signals, and I won't be publishing the volatility chart this week. Hi, this is Lara at Elliott Wave Gold with your end of the week video analysis for the trading week ending Thursday the 29th of March, with markets closed for Friday the 30th for Good Friday. I'm expecting a downward swing to continue to support, but I'm not expecting it will move in a straight line. There will be a bounce within it, and I'm expecting that bounce may very well arrive Monday, Tuesday next week, and then some more downward movement back into the support zone, which is about 1310 to 1305. When that's done, I'll be looking possibly for an upward breakout. That's what the main wave count expects. Let's do the classic analysis first this week, because I think it just makes a little bit more sense with this current consolidation for gold. Currently at the weekly time frame for gold, we've got this consolidation zone. We've got a resistance zone about 1365. Final resistance above that will be at 1375, and there's a really strong support zone about 1305 to 1310. During this consolidation, it's an upward week here and another one here, which have strongest volume, suggesting that an upward breakout from that consolidation should be more likely than a downward breakout. Now that trick does not always work, but it does work more often than it fails. On balance volume, a bullish signal here with a bounce above support, and now I've drawn a new resistance line. So we've got a new small range that on balance volume is constrained as. If we constrained within, if it breaks above resistance, that would be a bullish signal. Below support, a bearish signal. ADX at this time though is telling us that at the weekly time frame there should still be an upward trend, and it's nowhere near extreme. There would be a very, very long way for it to run. To have real confidence in that, I'd really want to see a break above resistance on a day closing above resistance with support from volume, and then I'd have a lot more confidence in this ADX indicator here. At this time, ATR has been declining for a long time, and now it's flattening off. RSI is neutral. There's room for price to rise or fall. Stochastics also neutral. Room for price to rise or fall. What about the shorter term picture? Here's that consolidation zone on the daily chart. Resistance 1360 to 1365 mostly. Support 1310 to 1305. During this period of consolidation, it's this upward day which has strongest volume, suggesting an upward breakout may be more likely than a downward breakout. For Thursday's session, there's very light volume for a little bit of downward movement. A spinning top candlestick represents a balance of bulls and bears nearly, and indecision. We've got on balance volume at support. It may serve to halt the fall in price here, so we may get a bounce Monday, Tuesday as on balance volume moves higher. RSI neutral, room for price to rise or fall. Stochastics returning from overbought, now back into neutral. So look out for stochastics to continue lower, to oversold, while price continues down to support. But like I said in the introduction, do not expect when price is swinging from resistance to support in a consolidation for it to move in a straight line. That's not how it happens. There are corrections along the way, sometimes quite big, time-consuming corrections. That's what we'll expect here. And the bounce that I'm expecting could last maybe 1 or 2 days. It could even last a few days before we see the continuation of this downward swing back into the support zone. ADX at the daily time frame indicates there is no clear trend, and so it's telling us that there is at this stage here a consolidation, and volume tells us an upward breakout may be more likely than a downward breakout. MACD still bullish, and Bollinger Bands may be beginning to widen. They've been declining and then held steady. They might be beginning to widen. A new trend may be beginning, but it's not really enough of a change yet to have any real confidence that this contraction and then steady state for Bollinger Bands has changed. Okay, let's take a look now at the Elliott wave count. This is my first wave count. I have 5 Elliott wave counts at the weekly chart level because I'm looking at multiple different possibilities for cycle wave B. When a B wave is unfolding, it's absolutely essential to work with alternate wave counts. There are more than 23 possible structures B waves can take in terms of Elliott wave, and it's absolutely impossible pretty much until at the end to tell which structure your B wave has unfolded as. For gold, I'm not yet able to see a complete structure for cycle wave B, so the only thing I have reasonable confidence in is cycle wave B is not over and it's going to continue. This looks like the best of my 5 wave counts at the weekly chart level. At the beginning of my text article, for members only, I'm linking back every day to the previous historic analysis where I go over all 5 of those weekly charts, but I'm only publishing 1 bull, my preferred one this one, and 1 bearish to cover both different possibilities in terms of direction each day, so that it's manageable for me to do and manageable for you to digest. 5 a day would be far too much. Cycle wave B here is seen as a single zigzag subdividing 5, 3, 5. And the only problem with this wave count is we're trying to see this upward wave here, labelled primary A, as a 5-wave structure, and you have to admit it does have a better look as a 3-wave structure. For all of my weekly wave counts, if there's a problem, I've noted it with some text on the chart so you can compare and contrast all of those ideas. There's a 3-wave structure down here for primary wave B that has a really good fit, and primary C within cycle B has to be a 5-wave structure. It may only be an impulse or an ending diagonal. All the overlapping at this stage strongly suggests an ending diagonal. My preferred way to label this ending diagonal would be a zigzag here for 1, 2, 3, 4, and a zigzag for 5 unfolding. With an ending diagonal, all of the subwaves must be zigzags and the 4th wave must overlap 1st wave price territory. The rules for diagonals are quite different from the rules for an impulse. In order for other Elliottians and viewers to know your meaning, it's convention within Elliott wave to put the trend lines on a diagonal. Just tell others that that's the structure you intend. Diagonals normally adhere really well to their trend lines. We've got an overshoot here and a couple of little overshoots here. Prices quickly returned back within it, and so we're finding resistance here at the 1-3 line and support pretty much about the 2-4 line. And so if minor wave B here turns out to be relatively deep, I would not expect it to get too close to this invalidation point. If it gets down to the 2-4 trend line, it should find really strong support here. The diagonal is expanding because the 3rd wave is longer than the 1st and the 4th wave is longer than the 2nd, which means the 5th wave needs to be longer than the 3rd wave so that the rule regarding wavelengths for expanding diagonals is met. Intermediate 5 will reach equality in length with intermediate 3 at 1398.41, and so it needs to end above that point at minimum for the structure to meet all Elliott wave rules. For an expanding diagonal, the 5th wave does not usually overshoot the 1-3 trend line. It does almost always for a contracting diagonal, but quite rarely for an expanding diagonal, so don't expect that. I'll expect it to end maybe about the midline of this, between these expanding trend lines. So intermediate 5 has to be a zigzag subdividing 5 and complete 3, and then we'll need a 5 up. Let's take a look at minor wave B structure at the daily chart level now, where the high for minor A is this point up here. At this stage, minor wave B may be a double combination. I'm also going to consider the possibility of a triangle in the next daily chart. We may have a 3-3-5 regular flat correction, the first structure in a double, which is labelled minute wave W. The double is joined by a 3 in the opposite direction labelled X, which is relatively deep. That's typical for an X wave within a combination. And so now this wave count would be expecting most likely a zigzag down for minute wave Y. So minute wave Y within a double combination may be either a zigzag or a triangle, or minor B could be a double flat and minute wave Y could be a flat correction. So it can be a zigzag, a triangle, or a flat. Of all of those possibilities though, a zigzag is by quite a wide margin the most likely. In my experience, double flat corrections are actually very, very rare. I think I may have only seen 2 or 3 in my 10 years of Elliott wave analysis. And triangles within combinations are not as rare, but they really aren't very common either. What is the most common combination of 2 structures within a double is 1 flat and 1 zigzag, and that's the most common by a very, very wide margin. And so my experience tells me to expect a zigzag for this wave count for minute wave Y, is most likely by quite a wide margin. The purpose of double combinations is to take up time and move price sideways. To achieve that purpose, the X wave is usually very deep, and the second structure in the double usually ends about the same level as the first, so I'll expect at this stage minute wave Y to end about the same level as minute W, which is about 1303.08, which would expect price to move back down into that support zone and only slightly overshoot it, pretty much end there. This wave count expects a downward swing to not move in a straight line. We'll have a bounce for a B wave within it, which should show up at the daily chart, so the B wave within it should last at least 1 day, if not more. It could last a few days, of 1 or more green daily candlesticks or doji, or a mix of them. When it's done, we'll expect a C wave down into that support zone. So this has got really strong support from classic technical analysis. It expects the downward swing to continue, and when it's done, it expects an upward breakout, which is what my classic analysis is expecting. At the daily chart level, this is another structural possibility for minor wave B. It could be a regular contracting triangle. Within an Elliott wave triangle, 4 of the 5 subwaves must be simple ABC corrective structures. 1 of the 5 subwaves may be a more complicated multiple, and most of the simple ABC structures are almost always zigzags. So we could have a double zigzag here, a more complicated multiple for minute wave A, a single zigzag here for minute B, a single zigzag down now expected for minute C, then would be expecting another zigzag up for D, and a final zigzag down for E. This could be either a contracting or a barrier triangle. For both of those types, C should end about this point most likely, and it can't move beyond the end of A, below 1303.08. Minute triangles normally adhere really well to their trend lines, and the trend lines are quite often tested within the triangle waves. So you can draw the within the triangle trend lines, you can draw the trend lines from the ends of the waves of the triangle, and they're often tested between those ends. So this could be a test of the AC trend line, telling us that the AC trend line may sit along here, which tells us that minute wave C may very well end at this trend line here. Minute wave D for a contracting triangle may not move beyond the end of B above 1356.5 0.12, but for a barrier triangle it may end about the same point, so that the BD trend line is essentially flat. As long as the BD trend line remains essentially flat, a triangle will remain valid. In practice, that means D could end slightly above this point. That rule is not black and white, it's subjective. That's the only Elliott wave rule that has any area of subjectivity. When D is over, wherever it ends, then E would be most likely to fall reasonably short of the AC trend line, and for both a contracting or barrier triangle may not move beyond the end of C. So this basically expects choppy, overlapping movement probably for a few more weeks, for most likely a contracting but maybe also a barrier triangle, and then an upward breakout. So this idea also has support from classic technical analysis. At the weekly chart level, this is an alternate wave count. This is the most bearish of my 5 weekly charts, and so as a bearish option I'm publishing this on a daily basis. Here we're looking at the possibility of cycle wave B as a flat correction. Flat correction subdivide 3, 3, 5, and within them the B wave needs to reach a minimum requirement of 90% the length of the A wave. Here primary B would need to reach down to 1079.13 to be 90% the length of primary wave A, so it has to reach at or below this point, and this point is above that, and so we can't label primary B over here. Looking now at the structure of primary B, it could also be a flat correction, this one a regular flat subdividing 3, 3, 5, so this wave count now expects a big 5-wave structure down for intermediate C to reach a minimum of this, and so that's why the target is at 958 for intermediate C to reach 1.618 the length of intermediate A. Were it to only reach equality in length with intermediate A, then the minimum requirement for primary B would not be met, so that's why I'm using the next Fibonacci ratio in the sequence here, even though primary B is expected to be a regular flat. The problem with this wave count is the rarity of this triple zigzag structure. In my now over 10 years of daily Elliott wave analysis on at least 1 or 2 markets and up to 3 or 4 a day, I have only ever seen 2 before. If this wave count turns out to be correct, this would be only the 3rd triple zigzag that I've ever seen. So they're very, very rare structures that must necessarily reduce the probability of this wave count. And I've said it before, but I guess I'll say it again for those who are maybe not members or who are new to my analysis. One word of caution: if you're looking at other work online purporting to be Elliott wave, if you come across wave counts that use a lot of W, X, Y, X, Z, be rather suspicious, because in my experience they're actually very, very rare. If you come across anything that has W and Y and Z labelled multiples within them, be aware that that's not Elliott wave, because it violates, well, it could be calling itself Elliott wave, but it breaks an Elliott wave rule. And the Elliott wave rules are all bar one black and white. The maximum number of corrective structures within a multiple is 3. To label multiples within multiples multiplies that beyond 3 and violates that Elliott wave rule. Of all of the problematic Elliott wave work I've seen online, that's the most commonly broken rule. I think people don't understand that one. Okay, let's take a look at the daily chart now. Actually, no, sorry, I don't have a daily chart. I did have a daily chart, and I published that after Wednesday's session for Elliott Wave Gold members. It saw a first wave over here and was looking at this structure as a second wave correction, but this downward movement has made that incredibly problematic. I can label it a multiple, double zigzag, and it will meet Elliott wave rules, but it just does not look like a double zigzags. It doesn't have a slope against the prior trend. It's essentially truncated, although not technically, but the effect is the same. It's really problematic. I just don't want to publish that again. It's too problematic. So suffice to say, if this wave count is correct, there's a really big problem now in trying to see this here as the start of a new downward trend. Now that may be resolved, and maybe there's something I've missed. I've looked at lots of different possibilities, and I can't see a solution yet, so I don't think that wave count's correct. Hi, this is Lara at Elliott Wave Stock Market with your end of the week analysis for the trading week ending Thursday the 29th of March. Friday, New York was closed for Good Friday, so the week's a short week. I'm expecting more upward movement next week. The target is now 2737. If we see a new high above 2674.78, that'll add confidence that we are in an upward swing. At the end of the week, for Thursday's session, there's a bullish signal from both the AD line and inverted VIX, which supports the idea of another bounce, or the bounce continuing. Prices again bouncing up off support, which is both at a trend line and the 200-day moving average. In the first instance, we should expect support at the 200-day moving average until price proves otherwise. Elliott wave analysis first, classic analysis last for the S&P again this week. My wave count sees a big fourth wave at cycle degree over here, which overshot the big teal channel, which is copied over from the monthly chart, and the beginning of a cycle degree fifth wave. This fifth wave may only subdivide as an impulse or an ending diagonal. The lack of overlapping tells us that this may be an impulse, it's not an ending diagonal. So far, the impulse has 1, 2, and 3 incomplete. Primary 3 may only subdivide as an impulse. So far, it has 1, 2, 3 and 4 probably continuing further sideways, although I do have an alternate that looks at the possibility that it could have been over here. It's most likely continuing sideways, and it's most likely finding support at this trend line. I've drawn this trend line from the end of 2 to this low here and placed a copy on the end of 3. When 4 is over, I may have to redraw the trend line. That's Elliott's second technique. I'm looking at a couple of different structural options for intermediate wave 4. At its end, it may have reasonable proportion to intermediate wave 2 in terms of duration. Intermediate 2 was a double zigzag. It was relatively deep. It was over half the length of intermediate wave 1, so I'd classify it as deep if it's over half and shallow if it's under half. It was a 0.54 length of intermediate wave 1, and it lasted 11 weeks, and so for intermediate 4 to have reasonable proportion to intermediate 2, it may be expected to last a Fibonacci 13 weeks. It could even be as long as 21. Fourth waves can be more time consuming, particularly triangles. They're the most time consuming Elliott wave structures. Now, it certainly could have also been over here. It would have just been a single zigzag, so there's not much alternation between the double zigzag of intermediate 2. They're the same family of structures, but because if it's over here, it would have travelled quite a great distance, albeit quite quickly. The distance would give the wave count still the right look, and so my alternate looks at that possibility. We have to consider all possibilities. Intermediate 4 may not move into wave 1 price territory below 2193.81, but well before price gets below that invalidation point. If downward movement were to continue, this wave count would be discarded. If we see a clear breach of this teal channel at the weekly chart level with a full weekly candlestick below and not touching it, I would discard the idea that cycle wave 5 is continuing further. While cycle 5 remains incomplete, it should find support at the lower edge of this teal channel. After the overshoot, not even a proper breach at the weekly chart level, just an overshoot of cycle 4, cycle 5 has remained well within this channel. Okay, let's take a look. Oh, before we go there, a word about the targets. The first target now looks inadequate. The second target looks more likely. Cycle 5 has passed equality in length with cycle 1. It did that about 2,500. It got up there and the structure was incomplete and price just kept on rising. So I'm using the next Fibonacci ratio in the sequence for the next target. But that looks like it's not going to allow enough room for upward movement in the whole structure to unfold. So the next Fibonacci ratio in the sequence would be the next likely target for cycle 5 to reach 2.618 times the length of cycle 1. Along the way up, when intermediate 4 is complete, we'll have intermediate 5 to complete primary 3 to new highs, and then another big correction for primary wave 4 lasting several weeks, and another final fifth wave up to final highs, possibly up to the targets. When primary waves 3 and 4 within cycle 5 are complete, then I can add to the target calculation at more than one wave degree. At that stage, it may change or widen to a small zone. Let's take a look at the first possible structure. My most likely expectation for intermediate 4, where intermediate 3 ends here. If price does continue to find good strong support at the 200-day moving average, which is where it bounced up strongly here and here and here, If that continues, then intermediate 4 would most likely be a regular contracting or regular barrier triangle. A contracting triangle is more likely, but a barrier triangle is also possible. For a contracting triangle, D may not move beyond the end of B. For a barrier triangle, D ends around about the same level as B, so that the BD trend line would be essentially flat. That's not a black and white Elliott wave rule though. In practice, D can end slightly above B here. As long as the BD trend line looks essentially flat to the eye, a triangle will remain valid. That involves an area of subjectivity, and it's the only Elliott wave rule that has that subjectivity. When D is complete, then E may not move beyond the end of C. At this stage, I have to accept the possibility that C may not be over here. It certainly could continue lower. I could have this labelled wrong. We could have W, this could be A, B, C, X. We could have A, B, C, a second zigzag for a double zigzag for minor wave C. If minor C does continue lower, it can't move beyond the end of A, below 2532.69, but I think it's very, very likely that probably is over here. We're looking at a zigzag upward now for D. And if I've got minor C labelled correctly as a double zigzag, which has a really good fit at the hourly chart level, then minor waves D and E must be simple zigzags to complete the structure and meet all Elliott wave rules. At the daily chart, at the daily chart level, this is another structural possibility for intermediate wave 4. It could be a double combination. The first structure in the double, a zigzag labelled minor wave W. The double could be joined by a 3 in the opposite direction, which could be over here. We could be looking at the second structure in a double combination for minor wave Y, which may be a flat or a triangle. Much more likely to be a flat, because in my experience, triangles are not really very common structures within combinations. So I'd be expecting minor wave Y to be a flat correction. They subdivide 3, 3, 5. Within a flat, the B wave has to be a 3, and it must retrace a minimum 90% the length of the A wave. The B wave can make a new high beyond the start of the A wave. So if we get a new high reasonably above this point, the triangle, as I have it labelled, would be invalid, and we'd probably be looking at a combination for intermediate wave 4. Although that triangle is my preferred wave count, I have learned the hard way over the years to not, when I expect a triangle may be unfolding, to always have alternates, to not just leave it at that one wave count, because far too many times triangles are such tricky structures. I've labelled it almost complete, and occasionally even possibly complete, only for the structure to invalidate, and it turns out to be something else. The something else is almost always a combination, so I'll always consider a combination alongside a possible triangle. There's another way to label this combination. Still got a zigzag here for minor W. What if the X wave is over here as a relatively quick little zigzag, and minor wave Y begins here as a flat correction subdividing 3, 3, 5. Up until Friday's session, this was my favoured way of labelling intermediate wave 4 as a combination, but this upward breach of this Elliott channel makes this wave count now look quite wrong. If minor Y is a flat with minute C beginning here, then minute C needs to be a 5-wave structure. We may have 1, 2, 3, 4 and the 5th wave incomplete, but if it's incomplete, it should find really strong resistance at the upper edge of this Elliott channel. The fact that it hasn't done that at the hourly chart, we've got a breach now, that reduces the probability of this labelling for intermediate wave 4. At the daily chart level, here's another possibility for intermediate wave 4. It could still be a flat correction subdividing 3, incomplete 3, and then would need a 5-wave structure. So I'm considering a triangle, a couple of different ways of labeling a combination, and I'm considering a flat correction. I'm trying to consider all possibilities. If intermediate 4 is a flat, then it's subdividing 3, 3, 5, and minor B within it must reach a minimum 90% the length of minor A at 2838.85. It hasn't done that yet, so it would be incomplete. Minor B subdividing as a zigzag 5, 3, 5, and minute wave B within it, an expanded flat 3, 3, 5. So minor B now needs minute wave C to be a 5-wave structure unfolding upward. If price makes a new high reasonably above this point, then the triangle as I have it labelled would be invalid, and we may be looking at either a flat or a combination unfolding for intermediate wave 4. This is my alternate wave count. It looks at the possibility that intermediate wave 4 was a relatively brief zigzag but moving quite a great distance, albeit in a short time, and so as I said at the weekly chart level, the proportion between intermediate 2 and 4 would still have a pretty good look. They would be disproportionate in terms of duration, but because the distance travelled for intermediate 4 was so great, they still have a good look. If intermediate 4 is over here, then intermediate wave 5 to new all-time highs may have begun. It must be a 5-wave structure. It may only be an impulse or a diagonal. At this stage, let's consider an impulse because it's a much more likely structure, because they're much more common than ending diagonals. So we may have an impulse for 1, an expanded flat for 2, and minor 3 beginning. The target for minor 3 expects the most common Fibonacci ratio to minor 1. Within minor 3, no second wave correction may move beyond its start, below 2585.89. Let's have a look at some classic analysis now. At the weekly chart level, this week we've got almost a spinning top candlestick. Well, it really is pretty much, isn't it? This represents a balance in bulls and bears, a little bit of indecision. Again, still finding good support at the 40-week or 200-day moving average. Upward movement, or at least a balance of volume during the week, was upward. We didn't get higher highs, but we did get higher lows, and we do have a green candlestick. Upward movement during the week has a slight decline in volume, but to be fair, this is a short week, only 4 days of trading, and Thursday was probably a little bit quieter because everyone was going away on holiday a bit early. And so we can't really read too much into that. And so the decline in volume I'm going to read is only very slightly bearish, and I'm really not going to be giving it much, if any, weight in this analysis. On balance, volume has bounced up above support. I don't know if the support line is going to be tested again. If we get another bounce, and I'm going to start to draw a new support line up here. I could draw another almost horizontal one along here actually, but the movement up just a bit above support here, I'm going to read that as a bit of a bullish signal this week from on balance volume. RSI is neutral at the weekly chart level. This consolidation for the S&P has pulled it's pulled ADX down from very extreme. It's also pulled RSI down from very extreme, and look how long RSI managed to remain overbought, and look how deeply or extremely overbought it became. This consolidation has pulled it right back into neutral territory. There's plenty of room again for this market to continue on its bull run. ADX was very, very extreme for many, many weeks. Extreme is when ADX gets above 35 and above both directional lines. ADX, I'm using this as a directional indicator. I'm using it to tell me if the market is trending or if the market is consolidating, because our trading approach to a trending or consolidating market should be really different. So it's really important to tell what situation the market's in, and ADX is a really good indicator for this. So it tells us here the upward trend became very extreme, and now as it's declining, it's telling us that at this stage there is no clear trend, that price is consolidating. So we've got resistance final at the last all-time high, support now down here just above 2525. So we'll look at volume during this consolidation to tell us what direction the breakout may be more likely. That trick doesn't always work. It usually works, but there's a bit of a problem here for the S&P, and it's been a problem actually for a few years. Price has been rising on light and declining volume, and it's been able to do that quite sustained actually, which the textbooks tell us it shouldn't be able to, but it has been able to do that actually for years now. If you look at the monthly chart of the S&P and you look at it alongside volume, you'll notice a steady decline in volume, which is very unusual for a bull market. I'm learning that in the current market conditions, we can allow for price to drift on up, basically due to a lack of resistance ahead, possibly drifting slowly higher. The lack of volume below means that there's very little support below, and eventually when this market turns from bull to bear, the lack of support could see an absolutely amazingly quick fall in price. But we're not there yet. The conditions for the change or switch from bull to bear aren't there yet. MACD is still bearish at this stage, but it is a lagging indicator, and this is the weekly chart level, so I won't be giving that too much weight. What about the daily chart level? We've got this really strong support continuing at the 200-day moving average. Like I said in the introduction, I think it's a pretty safe approach to assume that the support about this average will continue until it doesn't. And in my text article, I look back over the last few years at the times the 200-day moving average has seen price move below it, and I look at how far, by how many points price travelled below it, and how long in terms of how many days price remained below it. So what happened in the last few years when price broke below this? The bottom line is it can remain below for maybe 3 or 4 days, and it can move below by, say, 80 odd points. And so if we do see price close below the 200-day moving average and even print a full daily candlestick below it, that does not mean we are suddenly in a bear market. It does not mean price must fall by a substantial amount more. It could only fall by 30, 40 or 80 or so points and then turn back above. The only reliable thing that we can use to go on market behaviour, and it's not even 100% reliable, is past behaviour. That's all we have. We have a slight decline in volume for upward movement for Thursday, so that could be read as slightly bearish. I'm going to read a little bit more into the long upper wick, though. That's a little bit more bearish because Thursday was a day just before a long weekend, and so I would expect maybe volume to be a little bit lighter there. But we might be looking for a bit of a pullback to start on Monday. And so my little second wave correction, this fits the idea for the Elliott wave count of a little second wave correction, moving a bit lower. Maybe it's going to be just a little bit deeper and longer lasting than I expect, but also maybe not, because we've got some interesting signals this week from VIX and the AD line. ADX is still increasing very slightly. It tells us that at the daily chart level, the S&P is in a downward trend, so we should expect that it's probably in a big major level correction. That's what ADX, the directional indicator, is telling us. ATR is showing some increase, but overall for the last few weeks it's been overall flat, although it is a lot higher than it was back down here for a long time, which is making life much more interesting for traders. On balance volume has given us a bearish signal here with a break below support. Checking resistance now at price support and moving down and away, a second bearish signal. Another small swing low has given another strong bearish signal from on balance volume. This now resistance line may serve to halt a rise in price, but it will allow for another maybe even few upward days before it finds resistance there. Bearish on balance volume and ADX telling us that there's a downward trend gives a little bit of support to the idea that price is still within that intermediate degree fourth wave, and we're going to see more downward movement within it. RSI is neutral at this stage. There's plenty of room for price to rise or fall. Stochastics is oversold. No bullish divergence at this stage. It can remain oversold for reasonable periods of time, and so that doesn't preclude further downward movement, but let's expect support at that 200-day moving average. MACD still bearish and Bollinger Bands expanding at this time. A little bit of volatility returning. What about those signals I talked about from VIX and the AD line? For Friday, both VIX and the AD line have made new small swing highs above the prior small swing high, but price has not yet. That tells us that although we got some upward movement, sorry, I keep saying Friday, I mean Thursday, although we got upward movement at the last session of the week, it comes with a stronger than expected decline in market volatility. This is inverted VIX. So the decline in market volatility I am reading as a bullish signal. I'm reading inverted VIX as a leading indicator. Likewise, I'm reading the AD line as a leading indicator. I've learned to do this from Lara. I have a lot of respect for Lara's because they're so well and so long established, and they deal just simply with data. I like that simple, clear, technical approach. So Lara's read the AD line as a leading indicator. The AD line has made a new small swing high, but price hasn't yet. If the AD line is a leading indicator, then price may well be pulled up to make a new small swing high. And so this is bullish. It supports the idea of possibly a brief or more shallow than expected pullback early next week, and then a continuation of an upward bounce after finding support at the 200-day moving average. That's all from me, and I hope that all of our members and viewers are having a fabulous Easter. Happy Easter, everybody.